Hello, Mavericks. This is Rob Reinhold. I will be flying solo with you today. Darren is not able to be here. And let me first start off with happy Juneteenth weekend. Now, look, depending on your age, when people get older, sometimes they're, I shouldn't say resistant to change, but, you get used to things a certain way. This holiday caught me by surprise. It's a new holiday. And I found out on Thursday that the markets were closed on Monday. And I'm like, what? For what? And someone said Juneteenth. I said, oh, okay. Very cool. So let's get into it. Hopefully everyone's having a good 3-day weekend here. But last week was a crazy week. Just another crazy week that we've had. It's the 10th down week over the last 11 weeks. I think it isn't since 2001 that we've had a streak like this. We have now lost the last 18 months of gains. So we're really losing some serious ground here. And there really wasn't anywhere to be safe. Energy has held up very well. Energy was taken out and shot. Utilities hold up pretty well. They were taken out and obliterated. So even the things that have been holding up, everything got hit. Everything got hit last week, except for the things that were completely sold off and obliterated, like down 80%. Those stocks actually had a little bit of a bounce this week. And so it's kind of a strange thing where all the things holding up, they rolled over and died, and all the things that people thought were dead actually perked up a little bit. It's just rotation of money, where it's coming out of and where it's going to. And we got the FOMC raise rates by greater than expected, 75 basis points. But the biggest deal was that they're now forecasting 3% by the end of the year. They were previously forecasting they'd be at 2.5% by the end of the year. So the market had to reprice. The market had to reprice because this is new information. The 10-year bond yield jumped up to 3.4. We now have mortgage interest rates at around 7%. Everything got re-rated. And so when interest rates go up, stocks go down. That's because people that invest in stocks know that there's risk of them losing 10, 20, 30%. If they could get a fixed rate of return that's very safe and stable at 5 or 6, all of a sudden stocks become less attractive. So higher interest rates is not good for stocks, especially high multiple stocks, high PE stocks, and growth companies. It really hits them quite hard. Economic reports were not great. One of the things we've been talking about is that the economic reports had still been holding up and the numbers looked okay. We're starting to see these numbers roll over just a little bit. And the one that was the most alerting to me was last week we had the Empire State manufacturing number came in negative. And this week we had the Philly Fed manufacturing number come in negative. Now, these regional manufacturing numbers are really the very first leading indicator of economic activity. Just think, someone has to order product that they're going to sell in their store. Well, they order that product 3 to 6 months in advance. What this is showing is that people ordered less, and actually it's in recessionary territory where they're ordering it for sales that are likely to happen 3 to 6 months down the road. So we're starting to see some softening of economic numbers, which a lot of people are already saying that we're in a recession. I don't think we're already in a recession, but I think we are at very little to no growth. But we'll have to see. We get GDP the third week of July. We did have a negative first quarter GDP. If we get a negative second quarter GDP, then it will officially be a recession. Now, here's the thing. Once it's officially been a recession, it's already been a recession for like 9 months. That's what they say is it's about 9 months of a lag time until it actually shows up in the numbers. So let's take a look at the charts and let's really take a look at where we are and how we've fallen and really try to figure out where's the market likely to go from here. So everything down pretty big. S&P down 6, NASDAQ down 5, Russell 7.5. Oil got absolutely creamed the last 2 days of last week. So on the S&P, take a look at just where we were just 7 or 8 days ago. We are up here at 410 on the spiders. We're down here at 365. It's a 55-point loss. That's about a 12% drop. And that happened over 7 days. 2 of those days were actually green candles. And the rest, again, this is just absolutely a stunning move. We haven't seen moves like this in a long time. And here's the disappointing thing was that we had a little bit of an opportunity to bounce on Wednesday after the Fed. And you can see this long upper shadow where it came up and then just settled right back down. Friday morning, like things like the Russell and the Nasdaq were up 2% at one point, and it came right down. This is not good price action off a bottom. Like this is the kind of price action you want to see off of a bottom. Here and here and things like this. Like even this candle, you could say, hey, that's a good candle to get off the bottom. You know, a candle like this was actually a nice candle telling you we're seeing a bottom. This one. The candles we got are just not good candles. And so I would love to come on here this week and say, hey, you know what? I think that was the bottom. I think we're very close to a bottom, and maybe that was the bottom, but I don't think there's going to be any significant bounce because we're not seeing what we typically see off of big falls. And then what happens is a bunch of people rush in, a bunch of shorts cover, and we get a nice explosive rally to the upside. We're just not seeing that kind of price action. So while I do think we are close to or at a bottom, I do not think that there's going to be any sort of rally of any note off this. Here's the cues. So really, I'm looking at probably staying in a base here. I do think we go up this week, but I don't think it's going to be very big. It's going to be some relief, but that's really about it. If we take a look at the VIX is still elevated. We didn't get these spikes like we did the last 2 times. Get that real sharp spike. I mean, yes, we got it early, but last week, the VIX actually declined, showing you that less people are buying insurance on their portfolios, which is not a good thing because once people buy insurance on their portfolios, they don't need to sell anymore. The more unhedged people are, the more they need to sell when it goes against them. So for me this week, I think markets are near a bottom. But again, I want to say with clarity, a market bottom doesn't mean a market bounce. So I'm going into this week thinking, okay, we're probably going to get a little bit of the pressure taken off. One of the big notable things we've seen this whole year is that from Wednesday to Friday of monthly options expiration, it's usually a pretty big down move. We saw that in February, we saw it in April, and we saw it in May. So a lot of the selling last week was likely options expiration driven. So with that gone, I think there's going to be a little bit of relief and pressure taken off the market. But I don't think there's people out there really looking to get back in this market. I think people that pulled out, they're very happy to sit out until the economic numbers start to look better again. We do have the markets closed Monday for Juneteenth. And for me, I'm looking next week at what oil does specifically. So let's talk about the positive things. So oil came down from 120 down to 110. Now look, 110 is still very, very high. That's not going to give anyone any sort of relief at the pump. We're still going to have inflation. But let's say oil continues to come down. And again, it's coming down because people are now looking at the economy saying, oh, there's going to be less demand if we go into a recession or if we just have zero growth. There's less demand than we thought there was going to be, so the price is going to come down. If oil can get down below $100 a barrel, what that is going to do is that is going to probably be the thing that brings in inflation and brings it down and makes it to where the Fed doesn't need to be so aggressive. And the stock market will actually really like that. And so to me, this week, I think you watch the oil market. And if the oil market bounces back and goes up to 115, 120, I think the market's in some trouble. I think the market's still going to work its way lower. If oil backs off down from 110, maybe down to 108, 106, 105, that's going to tell people, okay, the heightened pressure on inflation is being removed a little bit with this drop in oil. I think it's going to help those markets stabilize. So next week, we've got existing home sales on Tuesday and a couple other really small reports, but this is going to be a much different week than last week where we had so much news. This is going to be a more normal week where just the market action is going to dictate what happens. So we have a -3 on the markets. We are as bearish as we can get. Our three inputs are, we are below the 20-period moving average, we are below the 50, and they're both sloping lower. So look, we've been at a -3 since here. We went briefly to a -1 once we popped up, and once we broke back down, we're now back to a -3. So you want to be overall bearish. With that being said, we cannot ignore the fact that we just went down 13% in 7 days. There's likely going to be a little bit of relief off that, which is why we are at a +2 for the week. Now, +2 in this market can be pretty substantial. The ranges we're moving are so much bigger than like a year ago. Like a +2 week would have been like, hey, we think the market's probably going to go up 1%, maybe up to 2%. Now that the markets are moving 5% a day, this could be, a 2 to 4% rally in the markets. Look, this is just our forecast of what's going to happen. We could be totally wrong, but it's still a significant enough bounce to where, there's going to be some movement. However, we are at a -3 on the monthly outlook. So at this point, I know I am just waiting for shorting opportunities. That's what I'm waiting for, and I hope we get a +2. I actually would love to get a +2 or a +3 because I want to re-enter some shorts. I was not short enough when we really tanked. It was tough to get short in things that were just free falling. So I'm looking for an opportunity to get back on the short side. But at this point, I want to do it off of a bounce or a base. So let's go in through the sectors. And before we just jump into sector analysis, I want to go through my methodology of what I looked at this week because everything's a -3. Everything looks terrible. Everything is abysmal. And so instead of just showing up and saying, hey, they're all -3s, what I really tried to do this week was get relative strength. What are the sectors that didn't fall as much as the others? What are the sectors that when the market went down 13%, they only went down 4, 5, 6%? They still went down and they're still terrible. So anything that's given a positive rating, it's just the best of the worst. I want you to understand that. So like when we take a look at utilities, consumer materials at a 0, it just means that they're terrible. They're absolutely atrocious, but they're the best of the atrocious ones. And anything that's a -2 says it's worse than the overall market. So let's take a look at the performance last week. And the first thing that jumps out is down 17% in energy. Energy had been holding on. We've been riding energy higher all year long. And look, when you are a trend trader and you just keep trading with the trend, at some point you're going to have a losing trade. You know it. So if you've made money on energy all year long, you did not make money last week in energy if you were long. You just didn't. You lost some money. You gave back some of those gains that you've been wringing through the whole year. So the big question is that a major trend change to where energy is no longer a sector to be counted on, or is this a temporary pullback in a longer uptrend? We'll take a look at the charts here. As you can see, everything else, materials was down big, and utilities. Utilities, I have never seen, or I can't remember seeing, a week where utilities moved this much. They got clobbered. They got absolutely creamed. So let's take a look at utilities first. 2 weeks ago, this was a +2 sector. 2 weeks ago. And it just got crushed. We're coming down into some support area here. So look, when we're taking a look at all the other ones, this, again, it looks horrible, looks terrible. But the question is it the worst one? And the answer is no, it's not the worst. So I'm going to give that a 0. Here is communication services. And you can see here, at least utilities had some buying a couple weeks ago. This sector hasn't seen any real buying since really last November is when it topped out. It's in a long-term downtrend. We are overextended to the downside, but I think we base. I think this is a market that is not going to go up significantly. We're just going to base. So communication services, I think you can stay short in this sector. I think you're okay staying short. Look, I'd love to get a little rally over the next couple of days to be able to enter some shorts at higher prices, but I think this sector you can continue to stay short. Real estate. Real estate was doing okay. Again, we just take a look at communication services. It's been weak all year. At least real estate has held in. Recently, not so much. So it's not the worst. It's not the best. We're just going to give that a -1. Industrials has been going lower pretty much all year. And boy, this really steepened. I mean, that is just a really big move here in industrials. So I think industrials, we are likely near a bottom. I would love if we got a little bit of a bounce that I could enter in some more bearish positions. So industrials, I think you can stay short in industrials as well. Healthcare. Healthcare has really been weak lately. And if you really want to take a look at one or two sectors, healthcare and financials over the last 2 to 3 weeks have underperformed all the time. So we think we're near or close to a bottom. We could get a little bit of a relief rally, but we think that is an opportunity to re-enter some bearish positions. So as you can see here, we're not trying to catch these bounces off the bottom because we don't think this bounce is going to be very big. You know, like the bounce we had in March, it was a big bounce. The bounce we had a month ago was a 6% bounce. I don't think we're just going to get that. So we're not looking to play bounces at all. What we're looking is letting some shorts come to us. Right now, things are a little overextended to the downside. Don't want to enter it short here. Let's hope and pray that we can get a little rally for, 3, 4, 5 days, and then enter short positions again would really be the best entry point there. So healthcare, you can stay short. Financials looks atrocious. I know we disagreed on this one. I would have given this a -2, but I was overruled by some other people. So -1 it is, but for me, this thing is atrocious. Same thing. I would love to see a little bounce in here to be able to get re-short into this sector. Consumer. Look at consumer. What is going on here? Consumer went from being the worst to it's actually holding or trying to hold its May low. Everything else blew through its May low. I mean, take a look at the move in financials. We blew through that low 2 weeks ago. And so we come over here to consumer and it's at its low, it's holding. This is some relative outperformance. Now look, this is still a terrible chart. It's horrible. This is not telling you anything about going long. It's only telling you about going short. But remember, relative to everything else, this is actually holding on pretty well. And it's somewhere that I know I will be looking for some of my few bullish trades I look to put on over the next month. Technology, it actually was the worst in the first of the year. It's now just middle of the pack. It's terrible. It's atrocious. Plowed through its low 5 days ago. Probably trade in this area. So I'm just at -1 here on technology. And here are the real shocks here. Basic materials was looking just fine. I mean, compared to the rest of the market, to hold in for all of 2022 while the rest of the market is just getting killed, it got killed last week. So the question is the trend of higher commodity and higher energy prices, is that over? And if it's over, these are going to be some pretty good shorts. Or if it's not over, these are going to be some really good entry points. I've been trading now for 25 years, and this is what I've learned. Trends last longer than you think. So I'm going into this week saying, you know what? This has been one of the better sectors. If I'm looking for some long trades, I'm going to at least have my eyes open for some longs in materials. If it does end up fading, I will get short on the other side. I may take a little loss here on a long, but I've got no problem with that. Really, the same thing with energy here. Energy just got crushed. I mean, there's no other way to say this is such a big move. That is just an absolutely big move. Is it the end? Was that the absolute top of this energy cycle? Or Is the energy cycle still have some legs to it? And if it still has some legs to it, these are great little opportunities to enter some aggressive long trades. Anytime you get these big falls, you can see they've been good entry points. They've been very good entry points for longs. The big question is, again, no one knows. No one knows if that was the high or not. But what I do know is they typically last longer than I think. So I'm also going into this weekend saying, okay, you know what? I'm willing to give energy a shot here off of some pullbacks. So to rank them here, as I said, they're all -3s. They're all terrible charts. But this is where they rank relative to each other. So energy, utilities, materials, consumer, I think you look in those areas for any bullish trades. And the sectors I think you can stay short: healthcare, industrials, and communication services. All right, let's take a look at some potential trades out there. Last week, we made a trade on the utility sector instead of the real estate sector, and that was for a buy of NRG on the long side, but we said you need to wait for a bounce. Well, we saw what happened in utilities. There was no bounce. NRG went down every single day, so that would have never been triggered. And that's why we do triggers at Maverick, is that we want to make sure that we're only getting into things that at least have the momentum on our side at the time. We never buy things when they're going down. We never sell things when they're going up. It's always, okay, to buy something, we have to make sure that it's going up, meaning that at that moment, there's a supply and demand imbalance to the buy side. We never just step in and go against the wind and try to hope that the wind turns around in our direction. We are always trading with the trend, with the wind. So this week in real estate, we're going to talk about Welltower. Now this one, again, had a big run, February, March, April, and then these things fell out of favor as interest rates started to rise, and we came down, hit this base, and punched down. Okay. It is quite difficult to find good-looking shorts at this particular moment. The market just dropped 12%. There's really not going to be anything that isn't overextended. And if something didn't drop, you definitely don't want to short it because it's showing you relative strength. So understand that any of the trades I go through here, they're difficult to find good quality setups. So I'm going to go through the rationale here on this one because I looked through a lot of charts. And the thing I like about this one is I've got this really, really big band of resistance at 80. I've got a big band of resistance at 80. I don't think this is going to go down this week. I don't think it's going to go down maybe even 2 weeks. But I think this top of 80 is pretty solid. So I'm going to be watching this week. And once it gets up into the high 70s, I'm going to go ahead and just put on this bear call spread. And I'm hoping this thing can get up to maybe 79. If it can get up to 79, I'll enter this trade. I'll probably get $3.10 in a credit. That means I got $1.90 of risk. And I've got 4 weeks to just sit and wait. There's no theta decay. There's no anything. There's actually theta decay in my favor. This is a positive theta trade. So we just sit and wait. And if it does end up breaking down, it's going to be a really nice trade and we're going to get our max gain. Really not a sophisticated trade at all. Just go in. Hey, I got 4 weeks. I don't think it's going to go above the 80. And if we have any more selling in the sector, this is going to be a really nice trade on Welltower. All right, last week in communication services, we had a Meta short. We said, hey, be bearish Meta. And sure enough, it got hit down 6.7% on the week. So nice setup on that one. This week, Roku. Same thing here. Same thing here as I just talked about with Welltower. The candles on last week of Roku were actually very nice. If you take a look at Roku, Roku was only down fractionally. So Roku was bought pretty much every day of last week, even though we were trying to break below this support line. In the short term, there's no question that there are buyers in Roku. And you absolutely, this is not a short opportunity on Tuesday. This is a wait for confirmation. This has been one of the weaker stocks. What we want to see is we want to see it get back up into this range, like between the 20 and the 50 period moving average. And then when we get the turn like we did here, that's going to be the entry here. So I just want to make sure everyone's clear on this one is not ready to go. It's actually showing some relative strength here. I expect that to continue. I just want to be a seller when it peaks out. And now I've got these possible call spreads, but look, it depends on where it goes. If it rallies all the way up to 95, then all these things need to be adjusted. All these spreads will need to be adjusted. I couldn't find anything in communication services that I wanted to short now. Nothing. So this is the best I could come up with is, hey, let's let these things have their bounce and let's enter on the short side. In healthcare last week, we had a GlaxoSmithKline. We did a sideways trade, and you never want your sideways trades to move as much as this one moved. It moved down 5.7%. Now, the nice thing was it was a bearish butterfly. It was a bearish butterfly with the middle target price about 2.5% below. So it wasn't a disaster trade, but it wasn't a great trade. It was one of those that had a little loss by the end of it. This week, we are going to go through a short. This is another sector that I said I think you can continue to be short in. I want to find stocks that are in areas where I think there's some really good resistance on them. So this is very similar to the Welltower trade. I don't think it's going to go down more. Look, the candles last week, we actually closed higher than we opened on Monday. There was buying in this one. Same thing here. I'm looking at it saying, right now there's buying, but I think there's a big wall up here. Big wall up here around this 43 area. So stick out a spread here. If you want to go to the 15th, that's fine. But I'm just going to look at 2 weeks out saying, hey, I think somewhere in the next 2 weeks there is another leg lower. And if that's the case, this is going to be a really nice trade because I'm going to bring in $2.50 on a $4 spread. I'm going to have $1.50 of risk. Very clearly defined risk trade on this one on Novavax. In industrials, we had 3M as a short last week, and it performed nicely to the downside, down 5.6%. This week, again, this is another sector. I think you can stay short in industrials. Really, the same setup as I've been talking about is that, okay, what stocks do I think had a big fall, but they're not going to bounce back significantly? I like this one here. There's some good resistance up in these areas. So I don't think this one's going to bounce. And let's talk about this one. This one is shipping. They do dry bulk shipping and they do shipping of energy. If the economy is slowing down, shipping is going to be one of the first things that come down. We've already seen shipping rates fall substantially over the last month. This thing had a big run. This thing used to be like a $30 stock. It had a big run up to 90. It's now just on its way down. Business is going the opposite way of what it used to be going as. So the question is, same thing. It actually had a decent week last week. If you take a look at last week, it closed up from Mondays. Mondays open. We closed higher than it. So there's buying there. I get it. So I'm looking at what trades can I make to where I can just sit. And if it bases and then plunges, I'm going to be in a good situation for. So this one here, you're probably going to get closer to $4 on this one, maybe $3.80. And then you got $1 of risk. This is a very nice trade here of just saying, hey, you know what? I'm going to park some money out here for the next 4 weeks. If we do have another drop in shipping and in industrials, I'm going to make $4. If I'm wrong, I lose $1. I'll make that trade any day of the week. That is on Zim Shipping. In financials, we had Berkshire Hathaway B shares on the short side. It got crushed 8.1%, so I know that's been a good trade for a lot of our traders. Let's take a look at this week. Looking at the long side. So financials wasn't the worst sector. It wasn't the best sector. It was somewhere in the middle. So I wanted to look for some bullish trades. And I found this one. And one of the little pockets of strength, for any of you that are looking for these pockets of strength, Chinese companies, Chinese internet companies, and Chinese companies have actually held in very, very well over the last month. They've outperformed. Look, they've still gone down a little bit. This one hasn't, but most of them have gone down a little bit, but they've been absolutely outperforming. So if you're looking for these little pockets of strength, I think Chinese companies are actually looking really good at the moment. Futu Holdings, this is one of those. We had a big run off this bottom, and you can see this thing has pretty much ignored the bear market over the last 2 months. It's totally ignored it. The question is, how do you play it? And this is where I love to do diagonals. I've got a trade that I think could break out and run, but I'm not totally confident. It's right here, right now. So I'm going to buy the 40s, and I'm going to sell this Friday's 45 calls. If this thing takes off and runs this week, I'm going to make very little. It's a diagonal call spread. There's not a lot of upside in these. But if this thing goes sideways, I'm very comfortable just sitting here waiting. And let's say on Friday, it's trading right around $45, but the market looks good. I'll let these expire and just hold on to the June 40s. And if I can get a run next week, oh, that's a great trade. So I get paid to wait. If it breaks out and runs, I still make some money. And I get to make a new decision on Friday on this. So Futu Holdings in financials. Last week in consumer, we had Philip Morris on the sideways side. We had done a 100 butterfly, a 95, 100, 105 butterfly, just a weekly trade. And on Friday, it actually looked pretty good. We sold off in the end. I know that my trade was profitable, 10 cents. Very, very small profit on that one. But we did get more sideways action on Philip Morris. But it got a little bit away from us on Friday. This week, looking for a long here. This is a sector that is trying to hold its previous low. So showing us some relative strength. This here is another Chinese company. You can see it's done very, very well. I'm looking to do one of two things. Sadly, this one does not have weekly options. If it had weekly options, I would absolutely do a diagonal call spread. But since it only has monthlies, I've got to look at some other things. I do like this 10-12 bull call spread. So right here, I'm saying, hey, look, I got 4 weeks. I'm just going to get into this one. It's probably going to cost me about 80 cents. That's my risk. On the long side, I've got $1.20 to gain. So I've got a nice risk reward here. I'm just going to see what this one goes. If you want to be a little bit more aggressive, I think you wait for a breakout. And then you go long the calls and you close them out as soon as they top out. That is VIP shop in the consumer. Technology, we rated as a -1, so not the best, not the worst. Looking for some more longs out there. Here we've got Array. I believe they're a solar company. Just made a new swing high for the year a week and a half ago. That's amazing. There's very few stocks out there that you are going to find that just made new swing highs 2 weeks ago. We had a big pullback with the rest of this market, but it came right back down to the 20. And then look at Friday's candle. This is a stock that people want right now. It is completely, look, Friday was a rough day in the market, and Friday we closed well off of our highs. This one didn't. This one held. So yes, I know it went up 13% on Friday. But when I'm looking to see, okay, what is actually in demand right now on the long side, this one is really near the top of the list. I like the 12-15. Bull call spread. Say, you know what, I'm going to give this thing 4 weeks. And whatever happens in the market, I think this thing's going to outperform and be closer to 15 by the end of the month. Oh, and I forgot to update our trade last week in technology was short Coinbase, and Coinbase was down just under 13%. So let's move on to materials. Last week in materials, we did an Alcoa short, AA short, down 7%. So nice job on that one, traders. Very nice. This week, going on the long side again, I'm going to be playing both materials and energy, that this was a buying opportunity. I fully realize I could be completely wrong. And guess what? I've been wrong a lot in my trading career. I'm okay with this. I'm just going to make a clearly defined trade, and I'm going to give myself enough time, 4 weeks, and I'm just looking at a 90.95. This is like the wimpiest trade you can make. Take a look at this trade. It's going to be a 90.95, and I'm going to be able to get into this thing for like probably $1.10. It's going to be my cost, so I'm going to $3.90 in upside. And I've got 4 weeks. Now look, if this whole market turns over and we roll over, yeah, I'll take the full loss. I'm going to lose the whole $1.10. But if we get any sort of stabilization in materials and energy prices, this thing's going to be probably back up to at least 100. And I'm looking for the max gain there. So this is SQM. This is a minerals company. believe down in Chile. And in energy, last week we had Schlumberger, or as we called it, Maverick, Schlumberger, which is the phonetic way to say it. We talked about how energy was pulling back. We didn't want to get into it yet. We wanted to wait for it to bottom out. So we had Schlumberger. If it bottomed out, we wanted to buy it. It never bottomed out. And frankly, the bottom fell out from under it, down 22%. So we didn't touch it. It was in free fall. That's why we have triggers, so we don't get into those kind of trades. So looking at this one here, same thing. What's a stock that we want to be able to get into if this energy trend is still intact? It might not be. That might have been the top for energy. And you know what? I'll be the first person to be short energy when the trend changes. I'll be the first person. I have no allegiance to one side or the other. I just have an allegiance to my account value. It's the only thing. We've come back down. We had this big parabolic move up, and then we just had a big parabolic move down. We're down to support levels. I am not convinced that energy is going to bounce here. So what I'm going to do is I'm going to be disciplined and use our triggers, because as things are falling, if you put orders up here, say, hey, you know what? I'm only going to buy it if it bounces up significantly and it keeps falling. You can just move these orders down. And if it just keeps falling, you never get triggered. But at some point, we will get a reversal. And I wouldn't really call Friday's candle a reversal on this one. That's still a lot of red here. So I think this thing's at least 2 or 3 days away. But if we can get some sort of reversal, all of a sudden now we are buying it when there's actually strength. We don't buy things on the way down. We buy things on the way up. It's a little counterintuitive to some people, but that's the way you always get in when you have the supply and demand picture in your favor. Buying it last week, you had supply and demand against you all the time. You were hoping that the wind changed direction before you got knocked out. We don't do that at Maverick. So I'm looking at a 35.40. 35.40, very easy vertical spread. Probably going to cost about 90 cents, have $4 to 10 of upside. I think this is a great way to play energy. So we got like a 4-to-1 risk reward, and we've got a defined risk trade. Just in case energy continues to implode, it's a very, very manageable loss on this. Well, that wraps it up for the trading room. We are looking for a market bottom bounce. Boy, I wish I said look for a market bottom, not a bounce, because I don't think there's a big bounce coming in. It's very hard right now to find entry points for shorts. Very difficult. So my advice is just wait. Just wait a week or two. Let's see what happens. And we can get more aggressive, get back into the short side that we've been really all year long. So I think we're just kind of in a holding pattern here. I think you can take some selective longs in things that are outperforming. And I think there are some sectors that you can still stay short and be okay. This week, we're going to be meeting live twice on Wednesday and on Thursday. So check the calendar and get signed up. Thank you so much for joining me. Everyone have a great holiday weekend for Juneteenth, and we'll see you next week. Goodbye.